I do think gold's going to 3750. The second leg will start in Q4. Then we'll go all the way to around 6,500 to 7,000. Sentiment right now is really, really weak. I don't really care too much about leg two other than the momentum's here. But leg two is when I basically stop buying and sit back and wait for leg three to get out. And this is a trade. So at leg three, I will sell all of my minor stocks at the top of leg three. Now we might get a leg four. I think we will. If we get a leg four, I'm going to miss out on all that upside. Leg four means that we would go up to around 9 or 10,000. Number one, fight inflation. Number two, make sure the economy grows. Whichever choice they make creates a crisis on the other side. So if they focus on economic growth, they're going to print money and create stagflation, create more inflation, right? Create a crisis there, that recession that they don't want. The other thing, if they fight inflation, the economy is going to hurt and the economy is going to go into recession. So it doesn't matter what they do now, they're doomed. This is the reason why central banks are buying gold. Right now, I think we're going lower. Right now, gold's about 4,100. You can buy here. There's a lot of stocks that are absolutely on sale right now. But also, you want to be ready to buy that next dip. I do think gold's going to 3750 before November. Could be wrong. We could be breaking out here. But I'm expecting one more correction. And in Q4, I'm expecting a bit the leg two to begin. So leg one ended in January. So leg one was silver got to 120, 121, and gold got to 5,600. That was the end of leg one, the top of leg one, and now we've corrected back. And leg two hasn't begun yet. And leg two will begin when silver gets above about 4,400, 4,500. Once it gets above those levels, it's heading to a new high. The hard part's going to be getting above those levels, especially 4,800. I think when you get to 4,800, I think it's going to fit. We're off to the races to a new high. The next one, the next leg, I think that second leg will start in Q4. Then we'll go all the way to around 6,500 to 7,000. And it'll take about 12 months, maybe less from now. I think less than now. So Q1 of next year, I'm expecting everything to go up 100%. Which is quite a run, is kind of what we saw last time when we went from August to January, about a 100% return or more. So I'm expecting that same thing.
This setup has appeared before major reversals, yet most investors only notice after momentum returns. Don Durrett notes another correction may arrive before a stronger advance, but timing matters more than bold price targets. Institutional buyers typically accumulate during uncertainty, while retail investors hesitate until headlines improve. Patient positioning often beats emotional chasing when volatility dominates. Next, Don Durrett reveals why the toughest part of this cycle may arrive before the biggest upside begins.
That leg two. And then it'll go higher. So 100% return like in GDX between now and Q1, and then Q2, Q3, we go all the way to 150, 150%. And that's kind of around that 6,500 level. And that leg is actually the most important leg, because that's the leg when the sentiment comes back to the miners. Like, sentiment right now is really, really weak. The second leg is when these stocks start getting valued fairly. Like right now, they're undervalued. I mean, hugely, hugely undervalued, in my opinion. So the second leg is when they get fairly valued. And then at the very end of the second leg, some will be highly valued. But the third leg is when we make our money. The second leg is more, okay, we're starting to run here. The third leg is when we go up to between $7,000 and $8,000 gold. So we go to let's say we go to 6,500, then we correct back to say 5,300, and then we rip to 7,500 to 8,000 in leg three. And so we're waiting for leg three. Leg two, now for me, the speculator after the big alpha, I don't really care too much about leg two other than the momentum's here. But leg two is when I basically stop buying and sit back and wait for leg three to get out. And this is a trade. So at leg three, I will sell all of my minor stocks at the top of leg three.
Cheap assets rarely stay ignored once institutional capital decides sentiment has shifted. According to Don Durrett, the second leg is where mining stocks finally regain fair valuations before speculative excess appears. That distinction matters because disciplined investors build positions before optimism becomes consensus, not after financial television celebrates new highs. Protecting wealth often means acting while conviction is still unpopular. Next, Don Durrett exposes why the final surge attracts the most buyers just before risk quietly peaks.
Now, we might get a leg four. I think we will. If we get a leg four, I'm going to miss out on all that upside. Leg four means that we would go up to around 9 or 10,000. And a lot of people were expecting that. So I think leg four is absolutely a possibility, but I'm getting out in leg three. I think that, so gold, going back to my thesis, the Fed really has got, by what they've done here, by allowing debt to get to this level, to allowing the interest rates to get to this level, is they've gotten themselves basically trapped. Now they only have two choices. Forget about the dual mandate. Now they really only have two choices. Number one is fight inflation, and number two is stimulate the economy. And again, it's not about full employment. That's just a moniker. We have 1% growth, we're happy. Okay, we'll check the employment rate. That's just noise, if you will. What's the growth rate? So their true mandate is, okay, we want to somewhat control prices, but we want to make sure we have economic growth. Okay, 1% or better. Let's call it that. So now they only have two choices, right? Number one, fight inflation. Number two, make sure the economy grows. Now, whichever choice they make creates a crisis on the other side. So if they focus on economic growth, they're going to print money and create stagflation, create more inflation, right?
The Fed still talks about balance, yet every major policy choice now creates a different crisis. What Don Durrett is highlighting is a debt burden that increasingly limits genuine policy flexibility. Markets may focus on rate decisions, but the deeper issue is whether growth or inflation gets sacrificed first. That dilemma shapes long-term demand for hard assets more than daily headlines. Next, Don Durrett unravels why central banks are acting far differently than their public messaging suggests.
Create a crisis there, that recession that they don't want. The other thing, if they fight inflation, then the economy is going to hurt and the economy is going to go into recession. So it doesn't matter what they do now, they're doomed. This is the reason why central banks are buying gold. Because the central banks know, they go, holy crap, America's screwed. There's nothing they can do now. So they're like, we got to get out of these dollars. We got to get out of these bonds. Let's buy gold. We got to start playing defense or proactively offense away from, towards gold and away from bonds and stocks and bonds. Now this trend, it's not stopping. It's not stopping until the whole thing blows up. So in other words, this gold accumulation. Now the interesting thing is that the central banks are accumulating gold. The East is accumulating gold. Just last month, China bought in June 173 tons. So if you multiply that by 10, it's almost 1,100. So it's like 1,400 tons in annualized. Well, there's only 3,700 tons mined yearly. And India imports probably just as much gold as China does. So that's like more than 2/3 of all the gold. And this, okay, that's just China and India. Then you have to throw the central banks on top of that. So those three are basically soaking up all the gold, right? And they keep accumulating. Guess who's not accumulating? The West, Europe, and the United States. Well, eventually, they're going to want some gold.
Governments rarely telegraph concern with speeches, but their reserve allocations often tell the real story. Don Durrett's argument suggests that persistent official sector gold buying deserves more attention than short-term price swings. If large buyers continue absorbing significant global supply, while Western investors remain underexposed, availability could tighten unexpectedly. Portfolio protection depends on following institutional behavior rather than official reassurance. Next, Don Durrett reveals why the biggest future buyers may be those currently holding almost no gold.
I always say the people who are going to buy gold and silver are the people that don't have any. Like right now, they did a survey of 300 family offices. So these are basically affluent families that basically local people who are managing their money. And 30%, only 70% had zero gold exposure, zero. And they're like, why? Why would I want gold exposure? It doesn't, paper gold. No, no, give me that 20% annual return in the stock market. So 70% zero. And the other 30%, they only had an average of 1%, one. So nobody owns any gold. But when this thing does begin to turn, I call it the fear trade. So the reason why the thesis holds water, if you will, is the trends. The US government, the interest rates are going higher, the debt's going higher, the annual interest bill's going higher, and the debt bubbles are getting worse. Like the housing right now, housing unaffordability has never been at these levels. We're starting to see more bankruptcies in both businesses and households. There's no real green shoots out there other than AI. So the thesis for gold is just getting better and better and better. Your turn.
Some excellent points, Don. Thank you so much. And yeah, the huge problem is that it's not just the US, Don. The world is very much connected with the US equities. We see these passive flows from UK, from Europe, pretty much people's productivity going into these elevated markets. And as you said, once the tide turns, I mean, it's going to be a big, big problem. But
the biggest risk is often hiding in the asset almost nobody feels they need. This is where Don Durrett's thesis shifts from price forecasting toward investor positioning. If most wealthy portfolios remain concentrated in conventional assets, even modest reallocations into precious metals could have outsized market effects. Waiting for consensus usually means paying much higher prices. Next, Don Durrett exposes why global capital flows could reverse far faster than investors expect.
we don't need to go into that in much details right now. So again, thank you very much for your detailed analysis. So the thesis is intact and we have seen a correction. So does that, Don, in a way makes you happy? If that, do you see it as a buying opportunity? And would you be, because many people, they're trying to find some similarities with the 2011. And well, we had this huge, almost a parabolic run, and now we could see many years before we reach that previous high. What would you say to that?
I'm a speculator, whereas speculator is only about 1% of all, pure speculators like me, only about 1% of all investors. Now, some people do about 5% do a little bit of speculation on the side. And so those are the people that, they have their standard investments and they're like, oh, that gold's got a good chance. And so I'll go ahead and throw some money in that and speculate on that. And so I think the majority of people that are coming into the gold and silver are kind of they're not like me. They're not full bore, if you will. Most of the people that are coming in, they're just dabbling. They're like, okay, I want a little bit of exposure to gold. Give me some of these stocks that have this big alpha. It's like, I'm going to gamble a little portion of my overall portfolio. All right.
Corrections often reveal conviction long before they reveal the next trend. Don Durrett notes that most investors only allocate small speculative positions instead of fully embracing the broader thesis. That hesitation explains why major bull markets frequently climb a wall of doubt rather than widespread enthusiasm. Risk management begins with understanding your own conviction before volatility tests it. Next, Don Durrett reveals why belief, not price, ultimately determines investment outcomes.
And they're like, those are the ones that they don't really buy the thesis 100%. If they bought it like me 100%, they'd be all in like I am. So those people are like, okay, maybe Don's right, maybe he's wrong. In other words, they don't really believe it. And then your belief level is kind of on a continuum. You kind of like 25% Don's right, 90% Don's right, right? So this is basically predicting the future, literally. So I use $7,000 gold right now today. to analyze gold stocks, and I use $200 silver. And I look out, 2 to 5 years out, and 2 to 3 years is kind of my sweet spot. I don't care about the next 24 months really. I want to go. I'm looking at least 24 months out further. So I don't. So my thesis is not in the near term, right? In the near term, all I'm looking for is deterioration, which I'm seeing. Now, the one thing that I do is I accumulate. I want to accumulate as many stocks and as many shares as I can before this thing burns to the ground. And I think we're running out of time here. There will come a time when I stop buying. And I've been accumulating for 20 years, these mining stocks. I have like 168 positions. And I found another one last night that was really juicy, making 169. And so all I'm trying to do is accumulate as much as I can. And
Most fortunes are built before the crowd agrees the opportunity exists. According to Don Durrett, long-term accumulation matters more than short-term market noise. Whether those assumptions prove correct or not, extending your time horizon changes how temporary volatility feels inside a portfolio. Investors focused only on headlines often underestimate how institutions quietly prepare years in advance. Next, Don Durrett exposes why disciplined accumulation eventually gives way to disciplined selling.
so you want to buy smart, sell smart. So buying smart is buying. You want to buy dips. You don't want to buy. You don't want to chase these things. So when gold gets to, I don't know, somewhere around 5,500, somewhere in that the next high, I will stop buying. I'm done. I'm not going to chase these things. And then once it gets to 5,000, I'll be very selective. The ones that are the laggards, the ones that people are ignoring. But I won't be buying very much. And so my buying is coming to an end. And because I'm really trying to buy low and sell high, whereas most people that are going to come into this, they're not really going after the five bagger. They're going after the 25 annual return. If they can just get a 25% return or a 100% return, they're happy because they're looking for annual returns. Those people are going to be chasing this thing all the way to the top. They'll just be chase, 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 right? And that's the majority of people. But those are the people who are going to make me a lot of money because they're going to just keep pushing these stocks higher and higher and higher. But for us speculators, you want to be really smart when you buy, really smart when you sell. And so, now we're up to 40 trillion. Our interest payments are $1 trillion a year, and people are starting to catch on. People are starting to recognize this is out of control kind of attitude. I always knew it was going to happen because this is how it has always worked historically.
Retail investors usually chase momentum long after professionals have finished accumulating. What Don Durrett is highlighting is the importance of having predefined buying and selling rules before emotions dominate. History repeatedly shows debt expansion encourages late-stage optimism, just as risks quietly compound beneath the surface. Wealth preservation depends as much on disciplined exits as disciplined entries. Next, Don Durrett reveals why government debt changes the entire investment playbook.
Historically, governments have always pushed it as far as they could and then defaulted. That's what countries have done over and over again. They don't tighten the belt. When they get into a debt problem, they don't tighten their belt. And so what we just saw with the Fed yesterday, where they held and everybody thought they were going to raise rates. And I thought there's no way that they're going to raise rates because they've gotten into this situation now where you're over $1 trillion in interest payments. If they raise the rates, that's just going to go up. The average, I think, interest payment right now is around 3.5 on our national debt, 3.5, 3.75. And we have about a 4% 2 year. So they're getting so all the borrowing. I'm not sure what it is at 3 months, 6 months, 1 year, but all the borrowing is, interest payments are going higher. So how can they raise rates? They're basically, the one thing about the Fed is what people don't realize is the Fed has changed its mandate, but they haven't said so publicly. And as a matter of fact, Greenspan changed it. But nobody's really said it out loud, and everybody just keeps repeating over and over again that the Fed's mandate is basically containing inflation and full employment. And that's not it anymore. It really changed in 87 when Greenspan basically made a statement and said, when the stock market went down, I forget it went down around 25% in one day.
Official mandates rarely change overnight, but institutional priorities often do. Don Durrett's argument suggests debt servicing costs increasingly influence policy choices alongside inflation and employment. Whether investors agree or disagree, watching incentives rather than speeches often provides a clearer picture of future decisions. That perspective can reshape how portfolios respond to monetary policy. Next, Don Durrett unravels the historical shift that quietly redefined the Federal Reserve's real priorities.
When Greenspan made the statement and he said, no, there's nothing to worry about here. We will do whatever it takes to make sure that basically the stock market doesn't go down, the stock market goes up. And they call it the Greenspan put. Well, when he did that, he changed the whole dynamic of the Fed. Because at that point, the Fed really didn't care about full employment or low inflation. At that point, what they cared about was economic growth. So even if you have unemployment at 5-6%, that's fine with them. You're supposed to be down at 3 at full employment, right? They don't care about full employment. What they care about is economic growth. This is so important. So right now, Warsh, his number one priority by it's like 80-20, is maintaining economic growth, where inflation is like 20%. Okay, we'll keep our eye on inflation. We'll keep our eye on it. We don't want it to get out of control because ultimately that inflation could derail economic growth. So we don't want inflation to get out of hand, but the priority is economic growth. But they won't say that publicly. And again, they don't care about full employment. They just want economic growth. If you get a recession, right now we have an everything bubble. So if you get a recession in an everything bubble, we've never had this kind of situation before. Where you have basically a bubble in the stock market, bubble in housing, and a bubble in national debt. So all this is happening all at the same time. Back in 2008, the only bubble we had was housing, but now we have this multi-pronged thing. So if you get into a recession, basically it's going to get really, really messy.
The market still prices confidence even as multiple asset bubbles coexist beneath the surface. This is where Don Durrett's thesis shifts toward questioning whether economic growth has quietly become the Federal Reserve's overriding objective. If policy consistently protects asset prices first, investors should reassess traditional assumptions about risk and safety. Hidden incentives often matter more than public statements.